I can tell you this with absolute certainty. The difference between profitable traders and unprofitable traders isn't technical. It isn't about finding the perfect indicator. It isn't about discovering a magical strategy. And it definitely isn't about having access to secret market information. The real difference is psychological. Every time you place a trade, you're fighting something far older and far stronger than the market itself. You're fighting your own brain. Your brain evolved millions of years ago to keep you alive in a dangerous environment. Back then, survival depended on reacting quickly to threats. If our ancestors hesitated when they heard a sound in the bushes, they didn't survive very long. If they waited too long to run from danger, they became dinner. So the human brain evolved to prioritize speed, emotion, and instinct over patience and logic. That wiring helped humans survive in the wild, but in the modern financial markets, that same wiring becomes a trader's greatest weakness. Deep inside your brain is a structure called the amygdala. It's responsible for detecting threats and triggering the body's fight or flight response. When a trade suddenly moves against you, the amygdala doesn't see numbers on a screen. It sees danger. Your heart rate increases, stress hormones flood your bloodstream, your breathing changes, and the part of your brain responsible for rational decision-making, the prefrontal cortex, begins to shut down. In other words, the exact part of your brain you need for disciplined trading is the first part to disappear under pressure. This is why incredibly intelligent people can still struggle in the markets. It's not because they lack knowledge, it's because they're human. They're trying to make rational decisions while their biology is screaming at them to react emotionally. Let me tell you a story that illustrates this perfectly. Years ago, I spoke with a trader who had previously worked as an aerospace engineer. The guy was brilliant. He designed complex systems for aircraft and satellites. His IQ was probably higher than most traders you'll ever meet. And yet, he once had one of the worst trading meltdowns I've ever heard about. He had spent 2 years developing a systematic trading strategy. It had clear rules. It had strict risk management. He had back-tested it thoroughly. For 2 years, it worked beautifully. Then one week, during a period of intense market volatility, he experienced 3 losing trades in a row. Now, statistically, that wasn't unusual. Every strategy experiences losing streaks. But emotionally, those losses triggered something deeper. His brain interpreted the losses as danger. So instead of sticking to his normal position size, he doubled his risk on the next trade. When that trade lost, he increased the position size again. By the end of the week, he had erased 6 months of profits, not because the strategy stopped working, but because his emotional brain took control of his logical brain. This happens to traders everywhere, every single day, and it reveals an uncomfortable truth about the markets. Trading is not primarily a test of intelligence, it's a test of discipline. Now let's talk about one of the most boring subjects in trading, risk management. It's not glamorous, it doesn't look exciting in YouTube thumbnails. Nobody wants to watch a video titled Proper Position Sizing Techniques. But this unexciting topic is the foundation of every successful trading career. Professional traders don't think in terms of absolute returns. They think in terms of risk-adjusted returns. In simple terms, they care about how much risk they take to generate those returns. Imagine 2 traders. Trader A earns 20% per year, but regularly experiences massive drawdowns. Trader B earns 15% per year, but keeps risk tightly controlled. Most new traders would choose the first option, but professional investors almost always choose the second. Why? Because volatility destroys compounding. Here's a mathematical fact that shocks many traders. If you lose 50% of your trading account, you must gain 100% just to return to break even. If you lose 75%, you need 300% return. If you lose 90%, you need 900% return. Those numbers become almost impossible to achieve. That's why professional traders focus obsessively on protecting capital. Their goal is not to win every trade. Their goal is to survive long enough for their edge to play out over time. Retail traders often do the opposite.
They increase position sizes when they feel confident. They take bigger risks after winning streaks. They believe they finally figured out the market. Ironically, that confidence often arrives right before their biggest losses, because markets have a way of punishing overconfidence. One of the most difficult moments in trading isn't after a losing streak, it's after a winning streak. Success can be dangerous. When a trader wins several trades in a row, something subtle happens psychologically. They begin to attribute those wins to skill instead of probability. They believe they've become better than they actually are. This leads to larger trades, looser risk management, and eventually a painful lesson from the market. Professional traders understand this dynamic. That's why many of them actually reduce their position sizes after big wins, not because they lack confidence, but because they understand statistics. Winning streaks happen, losing streaks happen. Both are part of the game. The key is maintaining consistency through both. Now let's talk about emotional regulation. Many trading educators say traders must eliminate emotions, but that idea is misleading. Emotions are not the enemy. Emotions contain useful information. Fear can signal risk. Excitement can signal opportunity. The real skill is learning to observe emotions without allowing them to control your decisions. Professional traders feel the same emotions as everyone else. They feel fear when trades move against them. They feel excitement when profits grow.
The difference is that they follow their trading plan regardless of how they feel. That discipline comes from repetition. It comes from routines, and it comes from treating trading like a professional process rather than a gamble. Successful traders often follow strict daily routines. They review charts before the market opens. They write down trading plans. They journal their trades. They analyze mistakes after the market closes. These habits might sound boring, but they serve a powerful psychological purpose. They create structure, and structure protects traders from impulsive decisions. Over time, consistent execution leads to one of the most powerful forces in finance: compounding. Compounding is often described as the eighth wonder of the world. Small, consistent gains, repeated over time, create enormous growth. But compounding only works if you avoid catastrophic losses. That's where discipline becomes critical. Retail trading culture celebrates huge wins. The trader who turns a small account into a massive fortune overnight. The viral screenshot showing a 500% gain in a single trade. But professional trading rarely looks like that. Most profitable traders build wealth slowly. They focus on consistency. Instead of swinging for home runs, they aim for singles and doubles. Over time, those small wins accumulate, and the difference becomes enormous. Now let's talk about discipline itself. Many people believe discipline is simply about willpower, but willpower is unreliable. It fluctuates depending on stress, sleep, and emotions. Professional traders don't rely on willpower. They rely on systems. They create rules that remove decision-making from emotional moments. For example, before entering a trade, a professional trader might go through a checklist. Does the setup match my strategy? Is the risk-to-reward ratio acceptable? Where's my stop loss? Where's my profit target? How much of my account am I risking? By answering these questions in advance, the trader eliminates impulsive decisions. Everything becomes mechanical. This is why experienced traders sometimes appear boring. They're not chasing excitement, they're executing a process. Over time, traders also evolve from reactive behavior to proactive planning. New traders react to the market. They see a stock moving and jump in. They read a news headline and immediately place a trade. They feel fear of missing out when others make money. Professional traders behave differently. They prepare for multiple scenarios. They ask questions like, what will I do if the market breaks above this level? What will I do if volatility increases? What will I do if my first trade loses? This preparation transforms trading from chaos into strategy. Instead of reacting emotionally, the trader simply executes the plan they prepared earlier. Another critical aspect of trading psychology is understanding your personal relationship with risk.
Every trader has a different tolerance for loss. Some people can handle large drawdowns without stress. Others become anxious after small losses. Neither response is right or wrong, but ignoring your psychological limits is dangerous. If you take trades that are too large for your comfort level, your emotions will eventually override your strategy. You'll exit trades too early. You'll revenge trade after losses. You'll abandon your system entirely. That's why position sizing is not just a mathematical decision, it's also a psychological decision. The best position size is one that allows you to sleep peacefully at night, because a calm mind makes better decisions. Finally, let's talk about the long-term perspective. Most beginner traders approach trading like a lottery ticket. They want fast money. They dream about turning $10,000 into $100,000 in a few months. Professional traders think differently. They treat trading like building a business. Their goal is longevity. They want to remain profitable year after year. When you adopt this long-term mindset, everything changes. Missing a trade no longer feels painful because you know there will be thousands of opportunities in the future. A losing day no longer feels catastrophic because it's just one data point in a long career. The most successful traders measure their progress in years and decades, not days and weeks. And this mindset brings us to the most important lesson in trading. Discipline is the ultimate edge. Every trader has access to strategies. Every trader can learn technical analysis. Every trader can study indicators. But very few traders can execute their plan consistently under pressure. That ability is rare, and that's exactly why it creates an edge. The market will test your patience, it will test your confidence, it will expose every weakness in your psychology, but it will also reward those who maintain discipline through every market condition. So the real question isn't whether you can find a profitable strategy. The real question is whether you can build the mindset required to follow it. Because in the end, the market doesn't reward the smartest trader. It rewards the most disciplined one. And that discipline, practiced every day, becomes the foundation of long-term success.